Good morning, traders. Here's your market update for today. Last week, the US dollar index traded in a relatively narrow range around the 99 level, even after weaker than expected US inflation data for September. The dollar started the week strong, but then that momentum faded as the days went on. Still, the index managed to close slightly higher, maintaining its recovery from the 2025 low reached in mid September. Heading into the weekend, the dollar's movement remained fairly restrained, a sign that traders are becoming cautious ahead of next week's Federal Reserve meeting. The market widely expects a Federal Reserve cut of 25 basis points. However, if inflation unexpectedly rises, it could reignite concerns about tariff-induced inflation, dampening expectations for a December cut. This would provide renewed support for the dollar. From a technical standpoint, the index is consolidating between key Bollinger Band levels, showing only modest bullish momentum. The RSI reading of around 57 indicates the dollar is mildly bullish territory, but without strong conviction. Unless the Fed delivers a hawkish surprise, the short-term bias remains slightly bearish. Turning to crude oil, WTI prices climbed above $61 a barrel last Friday, marking the strongest weekly gain, about 7% since early June. This rally was largely driven by new US sanctions on major Russian oil producers Rosneft and Lukoil, which together account for about 50% of Russia's oil exports. The sanctions aimed at increasing pressure on Moscow, having sparked fresh concerns over global supply. Reports indicate that some Chinese and some Indian refiners have already reduced purchases of Russian crude to comply with these measures. At the same time, the European Union imposed new sanctions targeting Russian energy infrastructure, and the Ukrainian forces have continued to strike refineries and pipelines at the same time. On the technical side, crude oil's outlook has improved from bearish to neutral, and now towards a bullish territory. The relative strength index has rebounded above the midpoint, signaling stronger upward momentum. While key resistance lies above the $62 mark, if prices can hold above this level, the next major test would be around the $64 to $65 per barrel mark. On the downside, support remains near the $60 level. Gold prices saw a sharp correction last week, falling to around $4,000 per ounce, a drop of more than 5% and the steepest intraday decline in 5 years. This pullback ended a 9-week rally, though prices did recover somewhat to around the 4,100 mark before the weekend. The sell-off coincided with large outflows from gold-backed ETFs, which saw their biggest one-day reduction in holdings in months. Since then, gold remains up roughly around 55% this year, supported by ongoing geopolitical tensions and uncertainty surrounding the US monetary policy. Sanctions against Russian oil companies have fueled risk aversion, keeping gold's safe haven appeal intact. Additionally, expectations that the Federal Reserve could cut rates again before the end of the year are helping to underpin these prices. Technically, gold remains in a constructive trend overall, with the RSI showing continued buying momentum. Though prices are still struggling to break through the resistance of around 4,186 to 4,200. On the downside, though, the key psychological support sits at around $4,000, with a deeper floor nearing somewhere about the $3,940 mark. Finally, the Australian dollar has been trading in a tight range around the 65-cent level. Investors are waiting for Australia's upcoming quarterly inflation data, which could play a key role in shaping the Reserve Bank of Australia's policy outlook. Markets expect headline inflation to reach the upper end of the RBA's target band at around 3%. At the same time, a recent rise in unemployment rate has led markets to price in a higher chance of a near-term rate cut, now sitting at around the 70% level. However, despite these expectations, employment remains strong and optimism about global trade relations, including a new US-Australia minerals agreement, have offered some support to the Australian dollar. From a technical view, the Aussie-US pair remains in a downward channel, Momentum indicators show a mild bearish bias, but the pair is holding above the key support level of 64 cents. A sustained break above 65.50 could shift short-term momentum towards a more neutral stance. So, in summary, this week's market tone is defined by caution and consolidation. The dollar holds steady ahead of a pivotal Fed meeting, oil prices rally on supply concerns, gold faces a healthy correction after record highs, and the Australian dollar awaits inflation data that could redefine the RBA's next move. As always, volatility may rise as central banks and geopolitics continue to shape market direction in the weeks ahead. Stay cautious.